Alright, folks. Hello, everyone. Welcome back. In the previous lectures, in Lecture 1 and Lecture 2, I've talked about the 11:15 to 12:10 p.m. macro, the lunch hour macro, and it is a unique model on itself. But in today's lecture, I'm gonna talk about the New York session, the 9:30 a.m. opening range trade, and the first presented fair value gap. Today I'm gonna talk about this model, and I've traded this model, and it was a break-even trade, but unfortunately I wasn't able at this time to record it live, so we are just gonna tape read it today. But as I said, I've took this trade and it was a break-even trade. It was not a loss, it was not a win, it was just a break-even. And here is the playlist. You can see 2025 MTJ live trades mentorship. You can go there and see the video. It is the Lecture.3. Alright, let's not talk more than that and go right into the charts. So as always, it doesn't matter which model, we always have to do the top-down analysis, the higher time frame analysis to find the higher time frame bias. Here on the weekly chart, we can see there's the weekly order block, as I mentioned in the two previous episodes, and there is the 50% level of it, and then the previous week, which was bearish, and it has a big wick, so we mark this wick out, and the 1 and 0 and the 0.5% level of it. You can see price traded down to it. This week it traded down to it and reacted very strongly of it, and it started to take off and go higher. And now we go one time frame lower to the daily chart. So here on the daily chart, we can see that there is a lot of sell side liquidity. Here we can see a fair value gap, a bullish fair value gap, BC, that price traded down to it and it reacted to it, which is also in area of the 50% level of the bullish order block, the weekly bullish order block. Then we can see that price has took out the buy side liquidity. It traded up to a daily SIBI, a daily bearish fair value gap. And we can also see that there are a lot of new week opening gaps above, a cluster of new week opening gaps, which price might trade up to them because new week opening gaps act like a magnet. Price gyrates to the new week opening gaps. It traded to it like a really, really strong pool of liquidity. So now we go lower to the 4-hour chart. Here's not really much to see. Besides, we can see that price has been consolidating this week, and it reacted to the 50% level, the consequent encouragement of the previous week's wick, the 50% level of it, and is trading higher inside the bearish fair value gap and trading up, aiming for the buy side liquidity. Then here on the hourly chart, it is pretty much the same. Wait a minute, there we go. Here on the hourly chart, it is pretty much the same. We can see that price has been consolidating. We can see the market structure a little bit, the lows, intermediate term lows and the short term lows. And here is the new week opening gap. That price has been consolidating around it here. And right now, I'm aiming for the buy side because price has been trading lower, took out the sell side, created a break of market structure, a displacement on the hourly chart, and now in my mind it is aiming for the buy side. So all the sell side liquidity that we can see here has been taken out. So here is another important factor. I know in the previous lecture, in the Lecture 1, I wanted to talk about rejection blocks, but I couldn't because the time was not enough. So here we have a perfect example of it. You can see that last down close candle, the swing low. We can see it has a big wick, so we mark this out. We can see the consequent encouragement right here. Price traded to it perfectly, okay? Perfectly, even by a tick. It traded to the consequent encouragement of it and started to trade higher. So this is a perfect example of a rejection block. So now we go lower to the 15-minute time frame. On the 15-minute time frame, you can see the midnight open and also the 5 a.m. So the end of the London kill zone. And I have marked out the 5 a.m. London kill zone, the end of the London kill zone, because the London session goes actually to the 7 a.m. But I use only the kill zone because the high and the lows of the London session most probably form in the London kill zone session. So I use the 5 a.m. instead of the 7 a.m. This is the reason why I use the 5 a.m. Okay? So let's go lower to the 5-minute chart. Here on the 5-minute chart, we can see the London low. That price has taken out during New York Open. Okay, price has been trading down. And we can see the London high. London high has been left in place. And price hasn't been even trading near it. Okay, none. It hasn't even been trading close to it. So now here on the forexfactory.com, you can see on Friday, there is no news. There's no high impact or low impact news driving the market. And well, if there is no news in the market, no high impact or low impact news driving the market, usually the London session is gonna be volatile, or the New York Open session is gonna be volatile. So the New York AM session, or the Asian session is gonna be very volatile if there is no news on that day. So in this case, New York Open has done a lot. It has been pretty much bearish, very volatile. But I just wanted to take one trade during the opening range, the 9:30 a.m., just to show you guys how this model works. But actually, that was wrong, because if there is no news on a Friday, especially on a Friday, because there is also the TGIF factor in game. I shouldn't have take this trade, but I still did it just to show you guys that this model actually works, even though there is no news in the market. But yeah, this was pretty much wrong. So yeah. All right, now we go finally to the 1-minute chart. Finally, it has been time. It was boring, all this higher time frame, right? It's all boring stuff. It's all boring. Nobody needs that. So here in the 1-minute chart, I've marked out the end of the London session of the London kill zone. Here's the London high, as we've talked about it. And another important factor is, of course, the London high has been taken out during New York PM session. I repeat, New York PM session, not the AM session, what I'm going to teach in this lesson. So another important factor is that we had a huge opening range gap lower. Okay. After the opening range, 9:30 a.m., we can see here the first presented fair value gap, which is very tiny. I've marked this one out. Let me zoom in. Here we can see it. The first presented fair value gap, okay? Which is just the first presented fair value gap after the opening range, 9:30 a.m. Doesn't matter if bearish or bullish. We mark also out the initial high and low. So in this case, I marked it out this low, this up close candle with the big wick, because I didn't want to see price trade lower to it. It was a taboo. It was a no-go. So if price goes down there, this is a sign for me that price isn't bullish. So yeah. And I also took the buy side, took the trade higher, because the displacement higher was very stronger than the first displacement with the first presented fair value gap to the downside, because the first breaker to the downside was also very weak. So this is why I took the second displacement higher with the fair value gap. So you can see here, there is this wick, price traded above the short-term high, the swing high. This isn't a valid breaker for me. I don't like this I don't take this as a breaker. This is a trap for me. It couldn't even trade lower. It could be a turtle soup. So this right there at this candle, this is a valid breaker for me, okay? Because I have a fair value gap below the 50% level of this displacement. So with the close of this candle and this fair value gap and trading higher above the swing high, the short-term high, this makes a perfect entry for me. This is my model. So yeah, this is why I did this right. I did it right there. So eventually, in best scenario, I would have been entering the market at the fair value gap below the 50% level. This shaded area, the blue shaded area, between these two up close candles, the bullish candles. But I've traded at the volume imbalance because right here you can see it at this candle. I've traded at this volume imbalance, this tiny volume imbalance, because I was concerned that price is gonna be very volatile and trade higher, but this was not the case. As we can see, it consolidated even really long time around my entry, so this is where I entered there, but that was, as we can see, wrong. So here is the 1 minute order block. That price traded lower to it. Here we can see it. That price has been trading to it. Oh, excuse me. Right here, this could also be another entry. Okay, not the order block. And then price created another fair value gap, and then traded higher above it, then below it, closed below it, then traded higher above it again. And at this point, I thought it would be a inversion fair value gap, but this was unfortunately not the case. It started to trade lower, and yeah, it just ignored this fair value gap completely. So right there, price has taken me out, because at this point I moved my stop loss to the break even, because I thought this is not a good trade. Because it doesn't matter if there is news in the market or no news in the market. Whenever price is consolidating around your entry, it's consolidating around your entry and spending really much time around your entry, you can know that this is not a good trade. Okay, even if at the end of the day it's a profitable trade, still, if it consolidates around your trade, you cannot know if it's gonna go against you or go higher. So this is a big sign for all of you guys, even especially as a beginner. If you're a beginner, you have to know this, that if price spends a lot of time around your entry, this is not a good sign. This is not a good trade. Get out of the trade as soon as you can, as a break even, or even with a small loss. Okay, so right here at this point, here we can see another re-entry at this first presented fair value gap. I'm actually just going to use it as a first presented fair value gap, because this is the bigger one than the first tiny bearish fair value gap. So here we can see price reacted to this order block and then traded higher, trading higher, and then this swing high. I wanted, even though I live recorded this trade, and I said in the video, I wanna see a close energetic trade higher above the swing high. I don't wanna see a price creating a wick and trading below it. This is weakness of the market. I don't like this. I want an energetic, like a rocket fuel, I want to see a rocket fuel, really energetic move above the swing high, the short-term high, and then close above it and then moving away from it. I don't want to see a close below it and go below it again and then go above it again. This is not a good sign for me. So this is why I closed the trade actually and as a break even. This was another reason for closing the trade for me. So yeah, here we can see I placed my stop loss below the low of this fair value gap. So the first candle of this fair value gap, I placed my stop loss there, and then I aimed eventually for the minor buy sell liquidity right there, which is even below the 830 opening. So it's actually really easy target to reach for, and it's as I said, it's below the 830 opening, and it is at opening range gap consequent encouragement. So it is at the 50% level of the opening range gap, and this is another unique model on itself. The opening range gap, it is a 70% win rate. That price at the opening range, it's gonna trade to the opening range gap consequent encouragement, the 50% level of it. But I don't want to confuse you guys, so I don't want to talk about it here in this lecture. This lecture is only going to be about the first presented fair value gap and minor and measure sell side or buy side liquidity. Okay, this is all you gotta know in this lecture. So here is the minor buy side liquidity that I've aimed for, and a small tiny fair value gap above it right there. This fair value gap. We can see that price eventually traded to it and then started trading lower during the lunch hour. As we have learned it, during the lunch hour, price will do a small retracement and then during the New York PM session, it's gonna eventually start going higher or trade in the bias of the day. But the launch hour is, it's 60% or 70% of the time it is very much a retracement of the daily bias. So yeah, and you can see that and go watch this as a proof in my first and the second lecture of the 2025 mentorship. All right, so don't ask me questions about how do you know that, how is that possible, MTG, how can you know that? I have proof, okay? Don't be stupid, don't ask me questions like this. Go to the YouTube channel, watch the first and the second episode, then you know why I've said that. So another reason for me to thinking like price is trading higher was the TGIF, the London high, and also this new week's opening gap. You can see here is the new week opening gap, above it is the London high, and also price has been below the midnight open and below the 8:30 opening. So I have many reasons right now to think like that price is gonna go higher. And let me clarify this for you guys. Whenever you want to be a buyer, you want to see price below the midnight open. Whenever you want to be a seller, you want to see price above the midnight open, okay? This is the premium and discount theory. And if price is bullish and it has traded below the midnight open during London session or during the London kill zone session, and now it is the New York AM session, the New York open, and it is already above the midnight open, okay? But it has traded really much higher, and it traded away from the midnight open. And at 8:30 AM, the 8:30 opening, price has traded higher. So at this point, you only want to see a trade below the 8:30 opening, okay? Because at this point we can know that price is really, really bullish, and it is not possible, or we don't want to see it all the way down, trade all the way down to the midnight open. We just want to see a trade below the 8:30 opening and start trading higher, because the 8:30 opening is the midnight open for the New York AM session, okay? It's the manipulation phase for the New York session. Know that. And it is exactly the same for the sell side. If we think that we are really bearish and price is trading lower, price has been, let's say price has been trading above the midnight open during the London session or during the London kill zone, and now it has traded lower during the New York open. It really has moved away from the midnight open. It has traded below it, and now at this point, it is exactly the same. We want to see during the 8:30 opening a trade above the 8:30 opening, and then eventually start trading lower, because this is a good sign of bearishness. All right, this is even this what I said right now. This is unique model on itself, and in this case, I had the price has traded below the midnight open, and it was also below the 8:30 opening, so it was really, really bearish at this point. And so at 9:30 at the opening range, I wanted to see a trade above the 8:30 opening, not above the midnight open, only above the 8:30 opening, because this was the easiest hanging fruit objective. So excuse me, I've talked about completely something else, but at this point you can go back in this video and you can see like 3 minutes ago, I've marked out the 4:14 or 4:15 p.m. because this is the close of the settlement. So this is we use the on the 1 minute chart, we use the 4:14 or 4:15 p.m. close candle, the 1 minute one. We use it as the opening range close, and the opening range gap open is the 9:30 a.m. Okay, this is the 9:30 a.m. is the opening range gap open, and then close of it is the 4:15 or 4:14 p.m. So this is the close of the opening range gap. In this case, I've marked both of them out, and we have this huge down opening range gap. which price eventually traded to the consequent encouragement, the 50% level of it, and took out the minor buy side liquidity and started trade lower during the launch hour. So now let me actually show you guys the trade that I've took at this point yesterday. Here you can see it. This is paper trading. I repeat, there is no real money involved in this trade. Here, this is the trade that I've took, okay? You can see the date here. That was the Friday. Today's analysis, what I've showed you guys. I used 20 lots or 20 contracts, but it was a break even. $16, okay? That was a $16 profit, so a break even trade. This was this trade right there, and you can see it on the charts that it is marked out. So at this point, you guys have a homework. I have a homework for you guys. I know you hate it, but still. Go to your chart and go 1 or 2 weeks back and use the 1 minute chart and use the 9:30 a.m. Okay, the opening range, and mark out the first presented fair value gap. Doesn't matter if it's small or big, and just look how price reacted to it. Okay, this is all. Yeah, and mark the first percent fair value gap out and just study how price is trading around it. So I hope you guys enjoyed this lecture, and till talk to you next time, be safe.